Drew Meredith, welcome to the finale of the Australian Investors Podcast reporting season. How are you, mate?
Pretty good. I might miss you for a few weeks or a few months.
Yeah, who knows? Maybe we'll come back in 2023 and look at how good healthcare's done and how bad resources have done. Maybe we'll put on a different hat. But seriously, if you're listening to this and you've listened through reporting season, thanks so much for tuning in every week as we went through these companies. We've got another 10 for you today. I've got one doozy, so like 4 decent results and one dog, for just to mix it up a bit. And if you want to send us your questions, I know some of you have sent questions in for companies for us to cover. Please send them to us. If you have questions on financial planning, portfolio construction, whatever, you'll find a link in the show notes. It goes to a type form. It's like a online survey. You can fill out the question anonymous. And also you can use a fun name. I've got a few names already sent through, which are a bit creative. So send your questions in. Drew and I will try and answer them on the show, and we'll have a bit of fun doing so. So Drew, a few weeks ago, we went a bit overtime, mate. So maybe today what we'll try and do is keep it to a few minutes for each company.
Good luck.
Yeah, here we go. Don't get me started on one of them. So I reckon we can just crack on, mate. So you've got a few blue chips, as you like to say, keep it nice and boring. But there are actually really interesting companies. So maybe
Definitely.
Do you want to kick us off?
Yeah, definitely. And I mean, it is pretty boring, but we've probably talked in the past. The reason we're always looking at the blue chips is because our clients are predominantly retired, so
Yeah.
or seeking consistent returns and less so worried about significant growth. So first one up, boring but super interesting at the same time, is Ramsay Healthcare. So one of the biggest, the biggest private hospital operator in Australia, and expanding pretty heavily overseas at the same time. So they own they do work and own hospitals in the UK and in France as well. There's a kind of an interesting backdrop to this one because KKR, the private equity firm, lobbed a bid for them. It was almost 12 months ago now, I think.
Oh, yeah. I was looking at the chart just now and I was seeing this massive spike. Okay.
Yeah. So there's a bid sitting there at $88 per share, and I think a big play on that is the property that they own. Obviously, they own quite a few hospitals as well as operate them. So the $88 a share bid, and that was kind of hanging over the report. The report wasn't particularly good or bad, and then KKR essentially, because the French hospitals are owned by, I think, another private equity firm, they could never get due diligence rights to look closely at those assets. So KKR's restructured the deal, still offering retail shareholders or anyone with under like $5 million worth of shares, $88, but everyone else would have to receive shares in that. It's Ramsay Desante, it's called. But I mean, if there's an industry that's been hit more by COVID, it was probably private healthcare. So elective surgeries cut, basically leaving facilities open or leasing facilities to the public system to help out with treatment. So not a great result, but could be a lot worse. Revenue up 3.1%, earnings down 20, profit down 40, but still made 274 million. And then the dividend was cut by 50%, essentially because you get less cash flow coming in, so you're keeping your payout ratio at the same rate. I think relevance is something like 9 months of lockdowns during the financial year.
Yeah, well, that'll do it.
Even elective surgery cuts. So, and then probably the more interesting thing more recently is they've spent about 2.7 billion. So they expand the mix or change the rooms or buy new hospitals or do greenfield or brownfield developments. And then there was a bit of press around them cancelling their deal with Bupa, the private health insurer. So they have to have agreements for treatment with all the health insurers and then renegotiating it. So just telling you that there's some pressure on costs and they're using their position to kind of negotiate back.
So I mean, Ramsay's one of these companies that's just grown like clockwork each and every year. It seems like that deal would be pretty palatable because the shares are trading at around about $71.
Exactly.
So
it's hard to sell at that price when you know there's still an offer. They don't like the new offer, but still an offer at $88.
That's okay, interesting. I mean, I mean, there's a few different ways to cut it, but I would, I know people personally who have held Ramsay shares for an incredibly long period of time and have done so well out of owning them. they would probably be disappointed to sell, to be honest, because they're receiving dividends and, you know, the business has grown very well since they've bought it. So I guess either way you look at it, you're probably getting a pretty, like, you're in a pretty good spot if you're a long-term holder of Ramsay shares. Do many of your clients own it?
Most, yeah.
Yeah.
So it's in our model. One of, I don't own it personally, but it's in our model.
Yeah, right. Okay. And so do you have a view on the takeover? Like, do you think it's good value, or do you think it's, you know, worth, you know, even if it doesn't go through, like what's your general view on it, I guess?
I think it's pretty good value, the takeover. So if it was trading close to that, you'd definitely be comfortable. The problem then is, where do you deploy it?
Yeah. Yeah, that's it.
But it's a pretty smart private equity firm, so I'm sure there's additional upside there. It'd be interesting to see what happened if they didn't have to shut down all their operations for 2 years, and where the share price would have been then.
Yeah, true.
Because backing this, you've got everyone says the aging demographic, but you've got massive lineup of, elective surgery, non-elective surgery, and the public health system in Australia is struggling to remain well staffed, and so it's naturally got this tailwind, I think, as an industry and a sector. So that's why we initially liked it.
So so maybe putting you on the spot here, would you buy it today?
Yep.
Yeah, $71. You've got that, I guess, that option of getting taken over at effectively $88.
Unless you're worried about another lockdown. I don't think we're getting any more of them. So
yeah. Okay, cool. I like it. It's RHC is the ticker symbol for Ramsay Healthcare on the ASX. Maybe I'll kick off with another R-related ticker, which is RPMGlobal. This trades under the ticker symbol RUL. Please don't get confused with RPM. That's an automotive company. I'm not talking about an automotive company. RPMGlobal is a business that's involved in software for mining companies, particularly coal, but also copper and other types of businesses. And the software is used for simulation of mines. It's used for like asset maintenance, so say where trucks drive on a mine site, wear and tear, those types of things. The big story, and people will know that I've followed this company for a very long time, the big story with RPMGlobal is since 2012, current CEO Richard Matthews has been at the helm and really kind of augmented the business to focus most of its attention on its software division, which, if you look at the operating level, has always been profitable. It's the advisory business, the consulting side of its business, which has often been at the whim of commodity prices in the cycle. And that's where it's been dragged down, and the unit economics aren't nearly as compelling. But there's also something else going on within the software division itself. There's actually three things. The business itself has gone from perpetual licenses, so selling one-off tickets for software, to actually selling it on a subscription. And the next thing is that it's actually moved all of its software, and this has just been completed, moved all of its software modules to the cloud. And then the third thing, which is happening soon, is the shift towards a SaaS-based model. So once you go to SaaS, then you can have, revenue uplift from increases of prices. It's very easy to add on modules.
Through scale. Yeah.
Yeah, absolutely. And so what we've seen over the last probably 3 years in particular is the business shift the mix from not just perpetual, but to subscription. So we've seen it kind of phase out that perpetual licensing, and the business has grown. The business has done a very good job of transitioning what is normally a very hard period. So through that period, because what happens is you typically receive a lot of the cash up front for perpetual licenses. It looks good. But it's basically gone now entirely to subscriptions. So for RPMGlobal shareholders, it's well done for sticking through it, basically, and holding onto your shares through this process. If you look at there's one slide that I'll call out from the results, and I'll just get to them in a second, is that there's a slide in there where it shows you the new product adoption. RPM has been rolling out more and more products or modules for different types of mining, for different products and services. And if you look at this new product adoption chart, it actually shows you that the business, like customers there's probably about 60 different companies that have taken on additional modules or additional products within the lineup. So it tells you that existing customers and new customers are taking on more. And so just in terms of the top line sales, $84 million, up 20%. Software was up 14% with the shift to subscription. So subscription revenue was up 69%. The advisory revenue growth came in at 48%. And interestingly, because of where we are in the cycle, being very positive for resources at the moment, they've got 6 months of work already booked, basically. So they're 6 months ahead of time, which is pretty good. There are times when the advisory division is the opposite way around, or maybe not the opposite way, but it struggles. Profitability, it actually reported a loss of $4 million. That's an improvement, but it's still a loss, so keep that in mind. There's a strong contribution from the software and the advisory business. So the advisory business, because of the cycle again, and the shift towards ESG consulting, has actually had an uplift there. It's still doing a buyback, which has continued post-reporting season. And for the first time, the company, at least I think it's the first time as far as I know, has given guidance. And they said that's because we've got clarity on our subscriptions now. We can forecast. And they've said they expect to report about $101 million of revenue, which is signaling 20% growth, and EBITDA of around 14.2 million, which would be over 200% growth. So the quote was, this is the quote, "With a rock-solid revenue foundation now in place, we expect a major revenue growth uptick and margin expansion," end quote. So pretty bullish outlook from RPM Global. The business...
In an environment where everyone's trying to extract efficiency. So they do like planning, and I think one of the big ones I just saw is emissions manager and sustainable technology. So understanding what you're emitting and reporting that to authorities is becoming more and more important. So having a tool, as you said, if they're selling it multiple things to the same buyers or clients, then it would suggest that they're doing something right and they're in the right area and niche.
Yeah, they are. There's another company on the ASX called Imdex, which is expanding outside of the exploration software, which is where it typically operates, and that's growing in this space as well. And so I think RPM, like, it's been sold down recently, and I think the company, while shares aren't super cheap, and I don't think they ever will be because now it's shifting to a higher quality business, I think for a small position in a portfolio, given that it is kind of a small cap, I think it's worthy of a small spot in a portfolio at today's prices. Just given that outlook of subscription revenue, the company has to deliver over the next few years, but it's a very high quality business with a really good management team at the helm. So that's RPM Global, RUL, ticker symbol.
I'd follow that with the next one, which is Wesfarmers. You'd say quality management and quality
definitely.
business too. Again, super boring. Actually, I think I sold it as the most interesting company on the ASX last time because it has battery tech, it has online sales, it picks up 30 cents in every dollar. It's like an oligopoly in terms of, oh no, it's not Coles anymore, sorry.
Yeah.
It's a monopoly in terms of Bunnings, and Officeworks pretty strong too. I think the challenge, we saw it with Coles and Woolies last week with Wesfarmers, is that comparable. So the devil of comparable, when you did incredibly well the year before. So I said solid, but not fantastic. Revenue was up 8.5%, but excluding the pharmaceutical business they bought last year in a bit of a bidding war, it was only up 4.9, which is probably slow for Wesfarmers. Profit fell 1%. 2.3 billion, and operating cash flow fell as well. So the dividend barely increased. And I think one of the highlights was, they said the second half profit growth was significantly stronger, like 13%. But they also own Kmart, which has been for some reason among the hardest hit of the retailers and department stores during the pandemic.
Which, I mean, I've never bought anything online from Kmart, but in person, it always seems to be busy. All the Kmarts that I go to, at least the ones that have like got the new branding and look good, and it's surprising.
Definitely. Yeah, I think there's some more competition from the big W's and the Targets, and I think we spoke on a few other times about inventory as well. So I think Kmart might have had issues in actually getting inventory. I think a lot of it came from China originally. So where some people had too much inventory, not having enough, and you're kind of stuck. But really, I mean, you look at the size of the business on a earnings basis, 2.2 billion comes from Bunnings, and out of a total of 3.4.
Yeah.
So you're like, really, it's 2/3 Bunnings. Does it really matter what Kmart's doing in there? And it's similar for the next, it goes Kmart next, and then the fertilizer and other divisions. So very much a play on Bunnings.
Yeah. It's strong business, right? Like I always look at Wesfarmers and think, yeah, it's strong for in a blue chip portfolio, fully franked dividends. It's pretty hard to go past it.
You pay a reasonable price for it, which is
Hmm.
always a challenge because you always pay more for a monopoly.
True. Do you think it's worth today's price? Like, do you think it's worthy of a spot in portfolios?
I do, yeah. For this, maybe not $60 where it was to begin the year. Everything
Yeah.
was at highs back then, and you kind of see within a portfolio you want multiple styles or different types of companies. So Wesfarmers being a staple or it's actually considered a retail or
Yeah.
sorry discretionary stock, but a staple. You want these kind of companies are the ones people go to when volatility increases and the tech sector and mining sector are struggling. They'll move to Woolworths and Wesfarmers and kind of the boring companies.
Yeah, it was trading on 2 times sales, which is pretty high for a very mature, as you said, discretionary retail business. Now it's about down to 1.3 times sales. This is a very crude metric, but it's, I guess, yeah, it kind of got a bit of ahead of itself, particularly now it's cycling out of those comps. One of the things is that when you get squeezed on operating cash flows, when you've got margin like they do, the free cash flows, once you subtract capital expenditure, it really takes a crunch. So free cash flow went from 2.7 billion to 1.1. So quite a step change there. Yeah, I like the business, to be honest. I always thought that the having it Coles with it was a good business, but even by itself, it's capable of growth. And once we cycle out of these COVID comps, Bunnings should be ticking along nicely as usual.
You want to buy it when no one else wants it.
Yeah.
So probably now.
Yeah, yeah, that's it. Because you don't get, like you said, you don't get a chance to buy a high quality company, let alone an oligopoly, at compelling prices. All right, cool. I like it, mate. I like it. I'll shift gears to A2 Milk, which is the A2 only protein dairy company. So the company has operations in China and Asia. It's got a small business in the United States, which is growing, but it's quite small. It's not profitable. And it's obviously got the Australian business too. I covered this company for Self Wealth Live on Wednesday night. For anyone that wants to dive into that, I went into a bit more detail there. But last few years, it's been a bit of a volatile ride for A2 Milk shareholders. And long-time listeners will know that I had a bet with Nirban Mohanty.
Never bet.
Never bet. And the bet was that if Penfolds got taken out, I would get a bottle of Penfolds. And if A2 Milk got taken over, he would get a bottle of A2 Milk. It was a pretty good deal for me. And I still think it's alive and well. So Nirban, if you're listening. But the company's been sold down in 2020. Share price got as high as around $20, now down to around like $5.70. So a big retraction from A2 Milk. And there are a few reasons for this: COVID interruptions in the supply chain, but also like a lot of tit for tat between Australia and China at the time. And so A2 Milk relied on the suitcase trade, getting infant formula tins over to China, buy it here on the shelves from Woolies. I've heard rumors that some Chemist Warehouse have post office attached to them, so they could basically stock and sell post it straight away to China. And so that kind of frantic behavior has kind of come and gone. A2 Milk had a bit of an inventory problem, and they've cycled out of that, which is positive. Sales up 20%. If you exclude the Matura Valley, which is, I'll get to that in a second, it's a manufacturing site that A2 Milk has bought. Its sales are up 11%, 25% growth in China. It went backwards in Australia, and the USA is around about $82 million of revenue. So if you compare that to the overall business at 1.4 billion, you get a sense of how small it is. Net profit, $123 million. It was up 52%. It was because of that big expansion in revenue. There's still a meaningful increase in things like marketing expenses, but the huge increase in revenue propelled the result. They're doing a $150 million buyback, but they've got $816 million of cash, net cash on their balance sheet. So pretty rock solid balance sheet. able to afford that buyback, no worries at all.
Top performer in the last few weeks, hasn't it?
Has it?
When I write my daily update, it seems to be going up when everything else is going down. So
yeah, right. It has come back from a low recently of around about $4. So if you think about that, $4, when was that? That was May this year, and now 50%. It's up. Yeah, so it's really bounced back, and I think that's just that China story. To be honest, they've got this. The focus on China is a volatile one because you just don't know what's going to happen when you wake up tomorrow with the focus on China, but it's growing quickly in that market, and it's got the kind of like the optionality of the US market, which is very competitive, but it's got that global diversification. The company seems to be guiding for a positive outlook in the year ahead with they said high single-digit revenue growth and EBITDA margin improvement, so pretty positive outlook. If you adjust for cash, so it's $4.2 billion market cap. You adjust for cash, you're down to about $3.5 billion on $1.4 billion of sales. That gives you some context around, I guess, the business and its valuation. I would say that A2 Milk was kind of the poster child. I think Bloomberg ranked it as the best performing stock in the world at one stage. And
that's when you sell, usually.
And that was a little while ago. I would just say, just be very mindful of where A2 Milk finds itself in the industry. So I'd have it as a very small position in a portfolio if I had it in a portfolio, simply because the Australian market is going backwards. The Chinese market is going forwards quickly. But to get to China, A2 Milk requires so much greasing of the palms. It's incredible. It's incredible, mate. Like, it's just incredible when you look behind the scenes.
The Daegu channels and
well, not even that so much. It's more like that too, but like who owns what? Like they bought this Matura Valley business, this manufacturing site. Well, that's controlled by the same Chinese group that gives A2 Milk the license to go into China. So
it's a trading stock. It's a speculated stock. Yeah.
Yeah. And so basically what happens is, A2 Milk finds itself in the middle of this cluster of Chinese state-backed organizations that has to negotiate with and get through. And that's why when we had the trade war, I can't remember who it was, someone from A2 Milk basically distanced themselves and said, "Oh no, we're a Kiwi company." And so yeah, it just be mindful of that. Like we saw that risk of it come to reality a few years ago. So if it pays off, it's going to pay off very well. But if we have some issues geopolitically, it might become a problem. So I think for a small part in a portfolio, why not? But just be aware of the risks. That's all I'd say. Cool, mate. That's A2 Milk. What's next on your list?
The perfect inflation hedge.
Oh.
Infrastructure, toll roads.
But no one's driving anymore. The roads are empty.
You'd be surprised every time I get on the road. I think you have to add 30 minutes to anything you do in Melbourne at the moment.
Yeah, that's been pretty crazy.
Peak hours like between 2 and 8 now. Atlas Arteria so ALX is the code. There's a bit of interesting stuff behind it. So IFM Investors, which invests on behalf of the industry super funds, owns about 15% of the company. Everyone was expecting them to make a bid to take it private. There's this big difference between what a private investor like an industry fund is willing to pay for a toll road that they can manage versus what the listed market is, which is quite strange. But if you're private, you can have more debt on it, you can be more patient, you can make changes.
For sure.
But the stock jumped, so they own toll roads in France and the US. I won't try and pronounce any of them. I think traffic surprise on the upside. So in France, apparently favourable ski conditions were central to a recovery in traffic. So cold weather, tourism picking up, COVID restrictions finishing, coming off a very low base. It's like when I think it was IFM bought, or the consortium bought Sydney Airport recently. So the price is still somewhat depressed. So any positive news contributes to a reasonably strong jump. And there's different ways to make money out of toll roads. One is that you're payments or your tolls are usually linked to inflation. So every 6 months or every year, the government essentially, as part of a contract, will increase it by a minimum of a certain amount. And usually that's linked to CPI, which obviously CPI is going crazy at the moment. And one of the other ways is vehicle mix. So if you get more trucks on the road versus motorbikes or cars on your freeways or your toll roads, then you get paid more. So traffic was up 23% on the main French assets. NPAT went up to, or profit was up to 117 million. Guidance was for another 20 cents per share in distributions, and the company kind of keeps expanding and improving. So they'll negotiate for more concessions for more toll roads, or they'll add a new lane, or add new entries or exits. It's one of the ways that they continue to make money. So I think it was quite an impressive one. The market liked it on the day, given what else was happening on the day when everything else was selling off. But there's always questions around bond yields and the value of infrastructure assets.
Yeah, it's analysts are still, just having a quick look here in ticker, analysts are forecasting very strong dividend growth into the future. That's kind of how I look at it. Would you, when you look at a company or an infrastructure play like this, how do you, what are the metrics that you look at?
Leverage. I always look at leverage because I'm always worried something bad's going to happen. And a risk with these things isn't the bond yield and the valuation, but rather the cost of debt going up and the cost of debt eating into your profitability.
Yeah.
And then, I mean, they're always going to look expensive. So you want to know how secure the income is and how hedged it is against inflation. But it should be bond-like. If you think about it, you've got an 80-year asset that's paying off dividends or income. So they do tend to, because people are looking for income, they do tend to oscillate on pretty big PEs.
Yeah, right.
Which is always something to be wary of.
It has bounced back a bit since COVID. It's been pretty strong, performer overall, hasn't it? Was this owned, pardon me, at one stage, did you say, was this owned by Macquarie?
Atlas Roads, it was called, yeah, Macquarie Atlas.
Yeah, thought so. Okay, makes sense. Cool. That's ALX is the ticker symbol. It's on the ASX. And do you have that in portfolios, in model portfolios?
No, we don't. We tend to use either an index or an active manager to get diversified infrastructure exposure.
Yeah, fair enough. Okay, so that's great. My next company is Fortescue. So Fortescue, it's pretty quick to sum up. Revenue went backwards 22%. There's a 4% increase in iron ore, but the cost that they received per ton of iron ore went down quite dramatically. It fell from $135 a ton to $99 a ton. So that's, quite a substantial retraction. So that's why revenue fell. At the end of the day,
cyclical stock.
Revenue is P times Q, price you receive times the quantity you produce. So when the price falls dramatically, that's what happens. Profit down 40% to 6.2 billion. Dividends for the full year of $2.07 fully franked. It's a final dividend of $1.21, which is down from $2.11 last year. Still great for Twiggy Forrest.
How many billion was that? Yeah. Was that 3.5 billion they reported in the paper?
Yeah, probably something like that. I just remember seeing the dividends last year. I remember it was something like an interim dividend of over $2 billion. And I was thinking, wow, incredible.
Imagine the tax on that.
Oh, wow. Maybe it's in a charitable trust. Outlook, the company, said it expects basically flat production with costs slightly higher. Costs were higher because diesel prices went way up, and also because labor and some of the consumables in the iron ore trade went up as well. So there's kind of that cost push in there. So over the year, I think the C1 cost, which is the cash cost at the mine site, like to dig iron ore out of the ground, it doesn't include things like head office expenses, administration, marketing, all that sort of stuff, like just actual costs at the mine site were $15.90 per ton. That's a wet ton. So the company does have its future industries business, which is kind of the push on green hydrogen. Fantastic speeches by Twiggy Forrest, Dr. Twiggy Forrest, I could say. If you want to find them, they're called the Boyer speeches, or the Boyer speech by Twiggy Forrest is fantastic. So the company's pursuing a pretty aggressive decarbonization too, which is positive. They're moving to renewable energies and trying to roll out things like trucks and trains that are, fully renewable. So if they can pull that off, it'd be a fantastic step for the industry as well as the company. So Fortescue overall, pretty good result. Analysts are forecasting lower dividends in the near term. So that's just a reflection of that iron ore price coming down a bit. And at the end of the day, that's the unpredictable factor. The outlook for commodity prices, in particular iron ore, looks robust, but you probably wouldn't say it was like it was, the last 3 or 4 years. So, the business.
People tend to extrapolate anything BHP, Rio, Fortescue, because everyone's short-term focused. They extrapolate short-term, $135 per ton iron ore sales for an extended period of time. So I think it's always going to be cyclical by its very nature. So if interest rate hikes are going to impact on economic growth, generally you're going to need less steel and iron ore, and prices should fall. So there's an old saying that, maybe it's not an old saying, but make it up, but you want to buy mining companies when the PE is high, because it usually means that the
earnings are depressed.
And you sell them when the PE is low.
Yeah, that's a good point. They've got quite a few $1 billion of debt on their balance sheet, $6.1 billion, and they got $5.2 billion of cash. Yep. I would love to see Fortescue without debt, for the first time in its life. It's always been leveraged and it's always been seemingly binary. If you took the debt out of the equation, I mean, I'm sure there's a reason for it. I haven't looked
free money.
Yeah. But I just feel like without debt, it would significantly de-risk the business. I get it can sustain it now, but I'd just love to see that business without debt. It'll just give it optionality and, a lot of breathing space. So that's Fortescue. Over to you, mate.
This one is difficult for me because I've made money and lost money. Probably end up breaking even on this one. It was late last week. So Zipco. I was one of those people who bought it at like 50 cents and then sold it at 6 and then bought it back at 4 and sold it at 10 and then bought it at 6 and still hold it at 90 cents. I think there's more comment, like the numbers are fantastic. Like anyone would pay for, you should be willing to pay for the kind of growth they're delivering. Transactions are up 62% in the US. Transaction volumes up 67% to 4 billion. Revenues up 70% in the US. Like, it's just incredible growth on all their businesses, albeit off a low base. It's just the massive challenge they have of, you've had cheap access to capital for a long time, and they're able to turn the capital over. This is what buy now, pay later business, obviously. They're able to turn that capital over quite consistently. But the issue they've had, one is valuations of technology companies, the ability to raise capital. And the other one was a jump in credit losses. So when you're doing buy now, pay later, if you have reason, they guided for less than 2%, but they had more than that in the last few years. It actually wipes out all of your profit. Even 2% on a average transaction value in the billions is quite a large amount. So some of the quotes, I couldn't imagine running this company at the moment. I think Afterpay sold to Block at the right time. As we look back on the past 12 months, it's clear the world is vastly different than when we started. And then you got the normal commentary you get. So there's some right sizing of the global cost base. That generally means cutting staff. And I want to share that we've already delivered a number of initiatives to reduce cash burn, manage credit losses, and improve essentially cost economics. So they're trying to lend more to better people and do it quicker.
Yep. Because obviously, if you can cycle that capital quicker, you can, even though your annual cost of debt might be, I don't know what it is in this case, might be 10%, 5%, whatever it is, I don't know. You can cycle that capital quicker and quicker. You can actually earn more of a return from your customers. It's they've got this medium-term target, which is seems pretty robust, of a net transaction market margin between 2.5 and 3%. So I guess if they could pull it off, maybe they can execute they can show some pretty meaningful upside.
Yeah, definitely. It's always going to be sentiment driven with the share price, which, you'd think it's worth more than 90 cents. And that's why it's the most volatile stock on the market at the moment.
Yeah, it's down a massive way, isn't it? Since, like you said, since those highs. So
not in portfolios, but in my portfolio.
Taking one for the team here, eh?
I'd put it in the A2 milk basket, I think.
Yeah, it's yeah, I mean, out of A2 milk and Zip, I don't know, I feel like they both have, if they can pull it off, they're going to have meaningful upside in massive markets.
Yeah.
But you just got to go into these things with your eyes open and just be aware of the risks. It's yeah, I think A2, I mean, Afterpay being hidden inside Block now is interesting because it makes it a bit harder to get proper comps. But it seems like the when Zip backed away from that deal with Sezzle, the market loved that, and I think it does show that the company is trying to, as you say, right size, but it's trying to focus on its core markets now, which is pretty impressive. So, and it's important for it to do now. It's kind of thrown everything at the wall. Now it knows what sticks. Let's just stick with that, which seems like the way to go. So it's Zip, ticker symbol ZIP.
Yeah,
so
it's much easier now. They got rid of the one in there. That was
Oh,
always typing that in.
Oh yeah.
Anyway,
yeah.
It was super annoying. So thanks, Larry. That was great.
And the thing is, I think when you do the dollar sign on Twitter, when you do the ticker symbol, I don't think it works when you put numbers in. I could be mistaken. Okay, so at number 4 for me is Alcidion. I'll be quick. Small cap company, spoken about a lot. It's a fan favorite for anyone that's on Strawman too. Alcidion reported pretty strong results, $34 million. And we already knew all this because they released their Q4, but revenue of $34 million, up 33%. Recurring revenue up 42% to $23 million. There was a 96% increase in the contracts sold. So during the year, which is a huge, huge amount of revenue to be banked in the future. Underlying EBITDA of $0.9 million. That's up from 0.4, I believe, or negative 0.4. I don't have the numbers in front of me. Gross margin declined slightly just as they shift the mix. So Alcidion actually sells third-party software along with its software. And so when it sells that software, it doesn't have the same margin, obviously. So dividends, no dividends, but it does have cash of $17.3 million on its balance sheet. So it's got a pretty rock-solid balance sheet, considering it's just turned into basically slight profitability or cash flow break even. The outlook, the company, this is where it's really interesting because it sells software to hospitals, particularly in the UK. Alcidion has already banked nearly the same amount of revenue that it earned this last year for this year when it entered the new financial year. So basically anything that adds from here is growth. They've recently, recruited very well. The UK, the NHS wants to make, I think, 90% of NHS trusts digital by December 2023. So that's 18 months or 12 to 18 months. So it is go time for Alcidion over the next 12 to 18 months. It's got to have to sell a lot more software because it wants to get into those hospitals before they go digital. Because as soon as they've already got their software packages, they're not going to just up and change to Alcidion. So they've made a few acquisitions along the way. Kate Quirk, CEO, not the founder of Alcidion, but a founder of one of the businesses that was acquired, does a very good job. So I think Alcidion, it fell recently during COVID. It got way ahead of itself. And I think, it's a small cap company. So go in with your eyes open, please. It's, going to be volatile. But I think for the most part, it's a really high quality, soon to be very profitable small cap company on the ASX. So the ticker symbol is ALC. That's Alcidion. And that's it from me. That's my number 4, mate.
Yeah, massively required in healthcare too. My wife's a doctor. I won't say too much, but there's even look during the pandemic. You remember we heard about contact tracing being faxed. Faxed. The fact that faxes are still used in some places is incredible. We've got an app on our computer that can fax, and people are still using fax machines. So yeah, I think there's a massive market but as you said, you have to be super aggressive and win market share quickly, I think.
Yeah, and that's what they're doing. They can ride on the coattails of some of their deals that they've already won. So as hospitals around the world go to digital, it's huge tailwind. Yeah. Cool.
My last one, sticking with wealth management again. I think we've done every platform almost, apart from
Hub, NetWealth,
Panorama, and
the
other one. So they're for sale. You don't want to review them at the moment. Praemium, so PPS, probably the best managed account or SMA, or one of the more popular platforms for that. So similar to Hub24 Net Wealth, you can hold, advisors use them to hold assets and get consolidated reporting, but they're also quite popular in the managed account space. So where advisors are taking discretion to manage client portfolios. Benefited from the same trend. So advisors leaving big groups like the old banks and insurance companies to start their own practices. Smaller market share than Hub24 and Net Wealth, but growing quickly. So record net inflows, 2.9 billion for the financial year, up 90%. Record profit. When they say in the results that it's a large, they don't even say the percentage, it's a large amount. The profit was up, I think, more than 100 times, probably because it was so low originally.
3,100%.
I just said 1,000. It was easy to say that. And how do you? Yeah. So it was, and once again, it's kind of like Alcidion, where you get, as soon as you get scale, these are essentially tech businesses. So once they get scale and profitability, it just keeps growing and growing. As soon as every client you put on is almost more profitable. So revenue was up 22, earnings up 21. They had a couple of random businesses. They sold one to Morningstar, so their international operations, and essentially they're getting flows into every part of their business at the moment.
And the good thing is, like, even though we're going through a very choppy part of time in markets, you can see, like you said, overall platform flows 2.9 billion, and the market went backwards 1.8 billion. So if you're looking at flows, probably don't look at that right now. You probably want to look at not just flows, but like you want to look at the overall mix and see how fast the platform is adding money, not necessarily the market movement on the total amount of money on the platform, because yes, they might not be monetizing as effectively, but sooner or later, that stock markets and all markets are going to come back. And when they do, all of that money that they're adding now will be worth more in the future. So,
and you want to look at the advisory groups they're setting up with as well. So they go out and sign advisors to their platform. So as long as they're growing advisors, I think is key there. They've been quite, one of the differences, we obviously reviewed all of them at one point. One of the key differences was their average balance, particularly with the Power App business they bought, is significantly higher than Net Wealth, Hub24, and most of the other majors. So
why is that?
They're quite good at alternative investments. So, private equity, venture capital, and dealing with the complexity and reporting of those. So they're more high net worth advisors use them as their platform of choice.
Right. Okay. So that's interesting, because Net Wealth always bangs on about being for high net worth clients and whatever. So, interesting.
Don't call.
No, it's interesting. So would you buy it today? Like, there's Praemium, Hub, and Net Wealth. You're a financial advisor. You've got experience with these products. Do you like any of them, all of them, none of them?
I think the multiples on the other two are almost too high, but then Praemium's is much smaller market cap, 350 million.
Yeah.
The Praemium had a takeover offer, I think it was from Net Wealth, that has kind of disappeared, which is that's the kind of challenge we have there. As a trader, I'd probably be doing PPS, and then at some point, Net Wealth or Hub24. You could just have small allocations to each if you like the platform sector.
Yeah, I think as an overall pie, it's super valuable, and they've got to capture space now that everyone's leaving the banks. And it's interesting because in this space, if you monitor the market, I know Raymond Jang does, who co-hosts the show with me every now and again. He has a spreadsheet which tracks the market share of all of the players, not just the listed companies. And Macquarie's platform is actually growing rapidly as well, which is kind of like this pillar that no one really notices. So that's Praemium, PPS. Maybe we can do a deep dive on platforms in the future, but good one, mate. So my final one is Dubba, DUB is the ticker symbol. Absolute dog of results. So the company didn't even, I did a tweet about this, so apologies if you've seen that, but the company came out and basically, let's just have a look. For example, in its investor presentation, it basically said that in FY22 reported a net operating loss of $46 million or thereabouts. That was down from a loss of $21 million, but that excluded share-based compensation, which was around about $20 billion. So in actual fact, if you read the unaudited set of results, it was $65 billion loss, and that was on revenue of $35 million. So, so there was a 15.3 million dollar increase in revenue for a $47 million increase in costs and expenses. So,
it's a tech company. It was fine 2 years ago, and now it's it's on the nose because of that, isn't it?
Yeah, severe cash burn. Severe cash burn. So the company does call recording. So if you've ever heard when you call the bank, this call is being monitored for quality and compliance purposes. That's the kind of software that they do, and they try to sign up networks, so like Telstra, British Telecom, so on and so forth. And then customers of that, so say like if BHP uses Telstra, BHP can use Dubba technology because they use Telstra as a carrier network. And that's basically what they do. They've got over 500,000 subscribers, they say, to their technology, but I can't find genuine reviews of the technology, and they never report ARPU, so revenue per user.
Feels like a time you want to be a private company if you're in tech and trying to grow, to be honest.
I would say that's true, Drew, unless
you need money.
Unless you want to pay yourself an exorbitant amount of money and you need to issue yourself 0 exercise price options.
Oh,
so issuing options to employees when they don't cost anything it's beyond me, how so
we had Kogan a year or two ago, wasn't it? But now their options are out of the money. Everyone was worried about them getting cheap shares, and now the options are out of the money.
But if the key point is, I guess, if you have 0 exercise price, doesn't matter what the share price is, as long as it's over 1 cent. So,
I think you're gonna get a call this week.
Anyway, I'll keep it short and sweet. I originally recommended Dubba and sold it after that. It's just too many red flags in the latest report. So for me, it's a pass. And that's Dubba. DUB is a ticker symbol. I know a lot of investors are very confident on it. And if it can, turn its subscribers into paying subscribers, keep them growing, it could experience a lot of revenue upside and the cost could mellow out. I hope that's the case. And I hope that the company kind of gets a bit tighter with its belt around that share-based compensation, because the thing about share-based compensation is you're giving away permanent equity for something that is not permanent. So when you give away equity in a company, that equity stays there forever unless you do a share buyback, right? Which is different to paying someone a wage, which is just like you pay it, it's done, it moves through the system. If they're no good, you get rid of them, done. But with equity, you give it away permanently. And so that's why we always say, like, look at that share count to make sure that the companies aren't just issuing shares for not getting the return. So maybe in the next year, like, the company could continue to compound rapidly. I think just be mindful, if you look at the revenue of the company, just be mindful of how much of it was acquisitions. I couldn't quite get a read on it, but I think most of the revenue that they earn is acquired revenue. That's WDUB. So just to reflect on our list today, Drew had Ramsay Healthcare, Wesfarmers, ALX, which is Atlas Arteria, Zip and Praemium, PPS. I had A2 Milk, RPMGlobal, which is RUL, the ticker symbol, Fortescue, Alcidion, and Dubba. So some great companies in there, some really interesting results. And it's good that I just love it, Drew, that you bring names that people know and pay fully franked dividends and all the rest of it. So
I won a couple of small caps this time. So
yeah, well, you got Praemium and you got Zip. So Zip's a small cap now.
It is now.
Yeah. So,
my pocket's super fun knows.
But I see it everywhere. I see Zip everywhere. I know a lot of people that use it. So Really interesting business. It's kind of like in the hearts and minds of people already in that mind share, which is so difficult to get. So, mate, like I said, we'll come back. If you have questions, you can send them through by using that link in the podcast player. You can find Drew at wattlepartners.com.au, financial planner, certified financial planner, based here in Melbourne, but has clients all over Australia. And you'll find more of the podcasts on rask.com.au or raskmedia.com.au. Drew, thanks for joining me, mate. Enjoy the rest of your day.
Thanks again. Looking forward to next year.